Welcome to Public Affairs Roundtable, a discussion of current events in the nation and around the world and how they affect the people of Indiana. Here's your moderator, Larry Lough.
It's been 6 months since the crash, the correction, the catastrophe of October 1987 with the stock market. And here in the spring of 1988, words such as anxious, nervous, even fearful are being used to describe the market and the investors. Today on Public Affairs Roundtable, we'll talk about those small investors, those big investors, and whether 6 months later we ought to be celebrating the survival of our economy, or should we be concerned that perhaps the worst is yet to come. Our guests today are Grant Wells, Professor of Finance at Ball State University, Kim Brown-Findling, Senior Vice President of K.J. Brown & Company, a Muncie-based regional brokerage firm, and she recently was elected governor of the Midwest Stock Exchange in Chicago, the first woman ever to be elected governor. And Bill Mosher, Associate Producer of Public Affairs Roundtable and a member of the Marketing Department of Ball State University. Kim, I saw a headline shortly after the crash, we'll call it for now, of October '87 that said the stock market will never be the same. Does that mean that we're going to forever have anxious, nervous, even fearful investors?
Well, I think that the complacency and the optimism that existed before October 19th has certainly been corrected since that point. Probably needed. I think that the whole industry realized that a lot of the investments that, some of the newer derivative type of investments that have been brought on board, and even good quality growth stocks, did have risk again. It taught the professionals as well as the small investor that there is a lot of risk anytime you enter the stock market, particularly if you are using some of the types of products that are margined, leveraged, that sort of thing. So I think it's going to take a long time for the nervousness to be out of it. I predict it will eventually, and but it has done quite a bit of damage to a lot of individuals that have been in the market.
The question, Granny, is the worst yet to come, or have we seen the bottom?
The major problem we have, Larry, is lack of confidence among the investors. There are many questions that the investors are really wondering at this time. Will the trade deficit be corrected? We're running about a $140 billion deficit at this time. This has caused a major problem. The other day we had a $13 billion trade deficit for the month of March. The market immediately went into a 101-point downfall. If we continue to have trade deficits of this type, the investor confidence will take many years for it to return. Other problems that we have would be the budget deficit. Congress is really not addressing the problem of reducing the deficit. The deficit this year will be approximately $150 billion once again. The budget was just passed recently, $101.1 trillion. Very little reduction in debt. Other problems, the third world debt. And this includes Brazil, Argentina, Mexico. Will they ever pay their debts? Another problem would be interest rates. Interest rates are now trending upwards. According to last night's news, the long-term 30-year Treasury are running about 9.03%. A recent article by C.J. Lawrence, I think it was Mr. Hyman, stated that interest rates could trend up a little in the next few months, but he is looking for 7.75% by the end of the year. If interest rates can trend down, I think the market will go back up. If interest rates continue to climb, then the bond market should do well. The stock market will not do as well.
A lot of uncertainties, though. You say there are a lot of variables still.
That is correct. There are many variables. The last one we should mention here is program trading. And this has placed the fear of God in many of the small investors, because they can start the morning off having a positive figure such as yesterday. We had a 30-point rise in the Dow. In the last half hour, program trading came in. The Dow ended down over 8 points. So we had a 38-point swing in one day. The little investor does not like this type of situation. This leads to a lot of uncertainty.
What, Kim, is program trading?
Oh gosh, there's all kinds of what we call this exotics now. You have the program, you have index ARBs, but basically what it is it's something that has grown and became possible with the advent of high technology. For the quote bannered around that we have grown technological to the point where our market structure and the regulation hasn't grown with it. We have out high-teched ourselves in the marketplace, and a lot of the blame for the crash has been, directly or indirectly linked to this. But program trading is really made part by the fact that we have lots of computer technology as well as computers on the floor that make a momentary execution possible like that. Because what you're going to do with the program trade is you're going to have a relationship either between an index option on an option exchange or a futures on an index futures on a futures exchange, which is trading, and there's a value there. And those indexes can be directly related back to a certain basket of stocks, a percentage relationship of stocks, for example, like one share of the S&P 500. So what will happen is when there becomes an imbalance, or say like a futures contract might be trading at a differential to the cash equivalent, then you can immediately, through the automatic execution system, take advantage of that. The computer itself is constantly monitoring the differences and can calculate, say, for example, your actual cost of doing it. And it's really a multi-million dollar type of a transaction that's just shot like that, like a cannon through all these different machines on the floor, and it spits up the orders and they're executed automatically, which puts a tremendous, all of a sudden, influx of either sell or buy orders at that moment. To the point that it's just overwhelming. And then if you have many institutions that are doing this type of thing, you have just a tremendous supply demand. And when we had a bull market going in 1987, we started having days up 60, 70, 80%. And that was directly attributed even at that time to the program trading, because they were out of balance on the upside as well, and that opportunity to profit existed. So you had volatility on the upside because of them, and of course you have increased volatility on the downside. You also have another strategy that you can utilize with either the options or the futures, which is a portfolio insurance. A large institution such as a pension or a mutual fund, they have lots of different equities that they are holding as in long-term investments. And if moment to moment their immediate perception of the market changes, for example, if they think that there might be some downside to the market, but nothing that they would want to totally go out and start liquidating their stocks for, they could hedge their downside. And there are all kinds of complex strategies, once again, dictated by computer to put this in effect. So we also had on Black Monday a ton of additional orders coming to the market as these large institutions were trying to protect their profits or hold their values. So we just had a ton of that all converging at the same time. That made very, very difficult days.
Bill Mosher, the upside and the downside must be really frightening for the small investor.
Well, Larry, I think it's not only the small investor. I think you also have the message and that's something that I'm particularly interested in, the message received by the general public, the consumer. There may be many consumers out there that are not necessarily investors, although Kim, I think, can indicate that it is a significant proportion of our population that does own stock in one way or the other. But beyond that, when you have the news that this is happening and have everybody wringing their hands and having trouble accepting these extreme changes and this sort of thing, then you have the question in terms of the consumer, should I make this major purchase? In other words, what does this mean? Does this really have, we've always felt that there was it had a barometric effect, that the stock market provided a barometer of what the economy is going to do. It was something that led the economy. It preceded, it gave you a forecast of what was going to happen. So if the stock market has accuracy in that respect, and if people, or even if they believe it, if the perception is there that is going to have, in other words, it's going to indicate the economy is going to move, then you may have the effect where consumers, and this has been borne out, the numbers have indicated about a third of the consumers have trimmed back their spending. Now it becomes two questions, and that is, do they invest it or do they put it in the bank, or what do they do with that money when they cut back on their spending? And there are some good numbers indicating that a substantial proportion of our population are becoming more conservative. In other words, about their general purchases, not just their investments, but their purchases as consumers. Do they buy a home? Do they buy a car? And then that becomes the significant question that comes out of that is, what does that say for our economy? Because this economic boom, which is really one of the longest booms we've had since the Second World War, longest sustained, although it's not an aggressive one, it's not upward at a very aggressive rate, it's still been stable on the upward side, has been really consumer driven. A lot more than the investment in factory investment, this sort of thing. It's been very heavily maintained by the consumer. If the consumer becomes skittish about the future, then that may mean that the economy even more slows down, which obviously will ultimately affect the companies that are the companies in the stock market that people are investing in. So there is a circular or a relatedness, I think, without any question, in terms of the message, the meaning, the implication.
Along with this, in regards to a consumer-driven economy, the question has to be asked, is the consumer spent out? We're talking here about $3 and $4 trillion in debt by the consumer. If the consumer does not have sufficient funds to continue spending, then there will be a major slowdown in the economy. As I mentioned earlier, one of the big problems we have, will interest rates continue to rise? If interest rates continue to rise, and I hope they don't, then this will lead to a major slowdown. I think that the economy will continue to do well, at least until the election. And then I think that the new president is going to have to make some major decisions. So I'm fairly optimistic at this time. I do have reservations regarding what will take place in January of 1989.
Obviously, if interest rates go up, consumers are going to be a bit more skittish.
That is, well, they'll stop buying cars and homes and your big purchases, and that will certainly have an effect upon the economy later on.
Grant, why are interest rates going to go up? What are some of the reasons that you can think of that should cause rates to go up?
Well, I think the major problem we have would be the budget deficit and the trade deficit. If Congress continues to spend more than they take in, someone has to finance the public debt. And in the last 3, 4, 5 years, the Japanese and the Europeans have been financing our public debt. The Japanese, in the last year, have lost considerable amount of money in the falling U.S. dollar because they've accepted dollars and the dollars have fallen. They have lost in that particular aspect. One of the major reasons why the market went up so rapidly over the last couple of years is that the Japanese and the Germans and the Europeans have been heavy investors in the U.S. market. They pushed the market up. October 19th, 1987, with a 508-point drop, the Japanese were big losers in the market. The foreigners were big losers in the market. So the Japanese lost two ways. They lost with the falling dollar, and it's still continuing to fall. They've lost in the U.S. market. Now, will they continue to buy the U.S. debt? If we are running a $140 billion debt, and it takes the Japanese and the Germans to buy our debt, they may want a higher return, and the higher return would be higher interest rates. And this is where the Fed is at this time. Do they push up interest rates, or do they keep them on a status quo basis? We have major problems, but I am still optimistic at this time.
I said we kind of thought we might get on here and build investors' confidence, and we're sitting here talking about all the problems. I think Grant's points are all well taken, and anybody today, part of the crash, part of the ramification is that through technology and through communication, the average person today is far more aware of all the economic problems we have. And I think that has another dimension of skittishness, because the average person today is far more aware of the budget deficit, inflation, how it robs their personal pocketbook, how it plays havoc with their investments, and also the stock market and its trends. I mean, you turn that TV on every night now, and you've got the dollar, gold, the stock market, the volume, and all these things. And so I guess what I'm saying is that people are a little more sophisticated, and they're a little more tuned into the short term. In the old days, a person would buy it, put away, and hold it for a long time, and really say, there was always people that would be attempting to do things more quickly. But today, I think there is more of a desire or more of a trend to have more of a short-term approach to managing money, whether you're looking at a mutual fund that has a quarter-to-quarter performance that they're being judged for, even the smaller investor. So that does add to additional skittishness in the marketplace, and I think it tends to take away from the big picture. And I think that that's something I'd like to talk about, is the big picture, because short term we've got the deficit, the dollar, interest rates, all these concerns. But yet really long term, what is it we're looking for? Why do people get in the stock market in the first place? And one of the things that I've seen, and I've been in this business 17 years, is people getting so focused on the short term that they lose track of the big term and they miss that opportunity. And you know, we had a stock market that went up, say, 2,000 to 2,700 very quickly, fueled by program trading, fueled by strong foreign investors' demand, and it virtually left a lot of the American public behind, because if you study during that period of time, they were buying bonds. They were buying bonds very heavily, and the statistics show that they really, the average person, even though they are a big factor, they still were not committing a ton of money to the stock market. And then we had a market way ahead of itself, and we had, I think, a correction exacerbated by the computer trading, by heavy leverage in various areas, and the way it came. You know, it just converged so rapidly that it did a lot of psychological damage, because people are expecting now the Great Depression to accompany that, and that's only natural that a person is going to think that way, and the consumer would pull back and everything else. Except that if you look at it again, you know, here we are 6 months later, and nothing is really falling apart other than the dollar being weakened. The big picture that I think exists is that we had in the crash a wonderful opportunity for people who missed the first, you know, a good part of the bull market to get in there. And also that there are going to be some risk as we have trended higher, you know, places. It is a market that will be volatile, but, you know, if a person looks at the whole picture, throughout history, our market has trended higher. We've had bull markets and bear markets, but American business is very, very bright. And I think that they just get brighter by the year. And I think we are looking at a worldwide market now that causes the Japanese have investments here. They have money to protect here. So they have more at stake with what we're doing and how our economy is doing and the rest of the world. So I just think it's very positive, and the average person doesn't like a deficit. We all realize that that is going to hurt us, and we're going to have Congress work on that for us as we go higher. So I think it's a very positive climate.
Grant, can we look at this big picture, or should we be looking at next January?
Well, I think we should look at the total picture here. I do agree with Kim that we just can't look at the short run.
But aren't we a people that tends to look at the short run,
that's
though?
our mistake.
Yeah. In other words, isn't that something we have
and
as a reality?
too,
yes,
I guess.
Yes. But getting back to Kim's points here, is that I think the market's going to be very volatile in the next few months, depending on a number of factors. But I think for the small investor, if you are really concerned about major volatility caused by program trading, then go into stocks outside of the S&P 500. Due to the fact that program trading, program insurance, involves the S&P 500. 500 of the biggest companies listed on the New York Stock Exchange.
Tell the general public what S&P 500 is.
Standard & Poor's 500 stocks. You're talking here about industrials, you're talking about utilities and transportations, listed on the New York Stock Exchange. If you're a small investor, and you are really concerned about complete volatility, a 100-point drop, 100-point rise. I think most of you are well aware that after a 50-point drop or rise, program trading ceases. You also realize on Monday that after the program trading ceased, after the 50-point fall, people were hand-delivering their trades and so forth to the floor traders. But let's get back to the small investor. There are thousands of good small stocks that can be purchased, put in the lockbox, and just put away for a period of time.
And they are down an awful lot from their highs from this bull market, aren't they? And they have, a lot of them haven't even begun to recover.
It's a good buy at this point, is that what you're saying?
I would think so.
I believe some of these could be a good buy, but you have to go through one by one, go through sort of a ratio analysis. You look at the price-earnings ratio, you look at the growth, you look at the sales, you look at the bottom line. What are they earning? You look at the product, you look at the management, and then you can make a decision. Some of these stocks, I believe, are cheap. Could we see on the screen here the first projection that we had before? And this was in regards to the, this goes back to 1975. It's a plus and minus chart showing the Dow Jones Industrial Average from 1975 up through yesterday, to be in fact.
But the peak was...
The peak was in August of 1987, and that's a little bit off the top of the chart. That line going straight down, all those zeros, that was the famous Black Monday, October 19th, 1987, when the market really fell 508 points. The point I want to stress, and I'm sort of going along with Kim here, and that is, if you're looking at the pluses and or the checks and the zeros, the trend has been up since October 19th, 1987. I would hope, ladies and gentlemen, that the Dow could get back at least to 2,200, because we were up to 2,722. The market dropped to 1,738. You had a 984-point drop there. We should recoup half. That would get us to about 2,250. And that would give me a little more confirmation that things are going well. The trend, as you can see from that chart, is upward. I believe that we're going to have a trading range this year between 1,900 to 2,100, maybe a little higher.
I like that prediction, Grant.
That's an awfully uneven line, though, that the trend is upward. There's a lot of up and a lot of down. That's by no means a smooth path on the way up.
Well, we have to be optimistic this morning.
That vertical, that strong vertical line, the one that goes straight down there so far, Kim has called it a correction. Do you agree?
No, that was a crash. That was a panic. That was a panic.
The effect may have been a correction.
We could say two points. It was a correction because the market was really overvalued about 19% at that time. One of the gurus in the market, Bob Prechter, kept talking the Dow going to 3,600. And did the Dow go up strictly on his prediction of 3,700? We don't know. Many prognosticators stated that the market was going to 3,500 to 4,000. I haven't heard many of those lately. Now some of the prognosticators are saying the other direction. I guess I sort of want to be cautious here, but sort of bullish at the same time. I'm more concerned after the election than I am right now.
But what you're really saying, Grant, on these small stocks and this sort of thing is you need to approach it just like you do buying products as a consumer. You need to do your homework and do your background and know your product and know the people behind the scenes that way, which is what an intelligent consumer does anyway. So there is a definite parallel to what we should be doing to make personal expenditures and that sort of thing, and that is do our homework, research it, find out about the company, not just jump into the situation.
I agree.
I was going to say another solution to the volatility problem is a lot of investors, you know, that are in the market have turned to the mutual fund industry. We've seen, you know, a lot more. The information is available, yet people don't have time, or they don't have the background. You know, they don't have years of being in this business, or you know, in the finance department at Ball State, and years of investing that Grant's done. And it's very difficult for the average person to sit down and say, I know I ought to have money in stocks, but where do I begin? So if the volatility and that sort of thing bothers a person, if you turn to a professional money manager and then let them select the stocks and let them go down on the floor and slug it out with the program traders and everything for you every day. I'd like to talk a little bit about the long-term record of stocks. I had a little some numbers that I got the other day that I thought were probably worth considering. And if we look at the inflation rate, since 1927 through 87, compounded annually, we had an inflation rate of about 3%. Now, my goal and the goal of investing is to best that, so that when you're retiring or whenever you know your life is your need for money that you're saving and investing comes, your purchasing power has been maintained, if not grown a little bit. So if you look at short-term treasuries, and if a person had invested their money from 1927 through 87 in short-term treasuries, they would have gotten about 4% on their money, average return. Longer bonds, like governments, would have given you 5%. So we're better than about 2% over the inflation rate, just looking at long bonds. But to take a look at stocks during that period, their average annual rate of return was 10%, twice that of the long-term bonds. So there's an opportunity there, the long-term, you know, the long-term to best inflation, and that's about 7 percentage points over the inflation rate. And of course, to double your return over the safety of long-term government bonds, you are going to assume some risk. And the risks that are typed. And also, just taking a look at the shorter term period, for the last 10 years, the S&P 500 that Grant was speaking of has returned an average of 15% a year. 5 years, we're looking at a 16% rate for that S&P, and in the last 3 years, 18%. So, you know, I think that going and trying to find professional money managers through mutual funds or other areas can take a lot of the guesswork for the investor away. And like Grant is saying, you might even want to be looking for professional managers that specialize more in the smaller cap companies, that sort of thing.
Where are you putting your money, Grant? When we talk about consumer confidence, look at the...
At the present time, it's going into a deferred tax shelter.
Which means?
I'm trying to get a good return so that when I retire a few years from now, hopefully I'll have adequate funds.
But it's safer than playing the stock market.
Definitely.
Well,
an understatement, perhaps.
It's safer. Will the return, will the yield or will the rate of return be as great? I don't know. But hopefully the risk will be a great deal less. But I'm still optimistic at this time.
Okay, we'll end it with an upbeat note, a note of optimism. Thanks to our panelists, Kim Brown-Findling from K.J. Brown & Company, Grant Wells, Professor of Finance at Ball State University, and Bill Mosher, our Associate Producer and a member of the Marketing Department at Ball State. I'm Larry Lough. Thank you for being with us.
If you have comments regarding this program, please address them to John Rouse, Box 149, Muncie, Indiana, 47305. The producer for Public Affairs Roundtable is John Rouse. Associate producers are Nancy Carlson, Steve Johnson, and Bill Mosher. This program is a production of University Media Services and the Department of Political Science. Facilities and funding are provided by University Media Services on the campus of Ball State University in Muncie, Indiana.